Welcome to our latest market update video. Today's date is the 8th of April 2026. So just briefly on key themes, equity valuations have eased over the last few months, but still remain above long-term averages. Geopolitical risks clearly have been a focus area for investors over the last few months, and rightly so, given their implications for oil prices, inflation, and general supply chain disruptions. But the other area of focus really coming into 2026 has been AI adoption and the implications of AI, both on the economy and corporate earnings. And we'll flesh out some of those pieces in today's presentation. Investment trends that we've been talking about for several quarters continue at a pace, including areas of AI, deglobalization, supply chain reorientation, as well as energy transition. These trends, amongst others, are leading to pretty strong corporate earnings growth, both abroad and domestically here in Australia. So in the US, for example, corporate earnings growth is expected to be about 15% this next 12 months. And in Australia, it's expected to be about 10% this year. Interest rates heading higher here in Australia. We'll talk more about that in today's presentation. In contrast, in markets like the US, interest rates are actually heading lower. Within fixed income, we think it's still a pretty good place to invest given the high level of starting income yields, as well as the potential for lower volatility, capital protection, and capital stability. Overall, we strike a cautiously optimistic tone at the moment, given the fact that markets have sold off recently. Valuations are a little bit cheaper than they have been in 6 to 9 months, and we're pretty much past peak fear as far as geopolitical tensions in the Middle East. So in the next part of the presentation, I'm just going to touch on the Middle East conflict, which is showing positive signs of easing as we speak. We'll talk about the AI build out and adoption and what that might mean for the economy and corporate earnings. And finally, I'll go through a few slides just looking at market drawdowns and how we think about that for investors. So as of the time of recording, we are on the 8th of April, and President Trump has announced a 2-week ceasefire in Iran. Interesting observation is that it's nearly been 12 months since Trump's last backflip, which was on tariffs in the US, which is a coincidental factoid. Here in Australia, the stock market is up 2.7%, which is the best day in over a year. And as we talked about last year, the TACO trade is back on. So Trump always chickens out is what that stands for. With the end of the military conflict in sight in Iran, it's led to a very strong share market response. Now, if I was recording this video last week, we would have been talking about the fact that we were pretty close to what we thought was a peak fear moment for markets, pricing in an extended period of conflict in Iran and what that would mean for supply chain disruptions, oil prices, inflation, and demand destruction more broadly. Historically, when we look at geopolitical events and wars, we tend to see that they tend to be short-lived. So within the space of months, 3 to 6 months on average, we do see markets bottom, we see oil prices peak, and about 12 months after a conflict, share markets tend to be about 7% higher on average, and positive about 65% of the time. So the conflict that has been going on for the last few months, whilst very disconcerting from a share market perspective, was always expected to be a relatively short-lived experience and episode. And as we sit here today, that certainly looks like it's playing out. The other big theme or risk that investors have been trying to price in and understand in the share market really coming into 2026 is what widespread AI adoption might mean for the economy, for productivity, economic growth, consumption, unemployment, and various other factors. What we've done is we've done some research, and our key findings are that there really are a few different possible scenarios that could play out over the next few years. One is quite benign, and one is a bit more destructive. The key conclusions are that we do expect to see a productivity boom as a result of AI investments and broad-based adoption. There is, however, going to be a cost to this adoption, and the key one really is the fact that unemployment is going to go up, particularly amongst white-collar employees, as these employees can be displaced most easily due to AI adoption. There are various limiting factors in this scenario analysis that we've done, and it really boils down to a few different things, including the pace of AI adoption, the ease of which labour can transition to other roles. New roles can also be created as a result of AI. And then also we've got to think about the fact that AI costs are an inhibiting factor. So if we think about what that means, it's really energy costs, hardware costs as the kind of limiting factors to AI adoption. Companies that have large white collar labor forces are really the ones that can benefit the most from this current investment boom. They're the ones that can displace their cost bases the most and really try and increase their margins, protect their cost bases. From our portfolio implications, look, there are going to be many, but the key ones that we observe at the moment is obviously it's the AI infrastructure owners, which is the hyperscalers and the hardware providers. Secondly, it's companies that adopt AI, and that could be companies in sectors like financials, banking, insurance, technology, and healthcare. Sectors where there are large pools of white collar workers that can be displaced. And really there's a third area, which is what we would kind of consider to be AI resilient or AI proof businesses. These could be hard asset firms. It could be in areas like commodities, for example, where you can't really replace your mining staff necessarily with AI as such. So those are kind of the three areas that we're thinking about when we're thinking about trying to build portfolios that have the potential to be AI resilient and potentially AI winners going forward. Next, I really just wanted to touch on the point about AI investment sustainability, because there is quite a bit of debate going on at the moment about how sustainable is the AI capital investment that's going on at the moment. And the fact is that there's about $3 trillion of capital that will be invested in AI over the next few years. The AI adoption that we're seeing is really being driven by demand, actual demand and accelerating revenues by the likes of the hyperscaler firms, Amazon, Microsoft, and Alphabet or Google. In terms of the demand supply equation, it still is very favorable for ongoing investment. There's still a lot more demand than there is supply, which is obviously supporting that investment going forward. In terms of the financial positioning of the firms that are making these very large investments, the hyperscalers, they are in a very strong financial position, net cash balance sheets. So quite a different picture to the prior tech investment boom of 1999. And finally, governments are also committing vast quantities of capital towards AI as well. So this is not just a private sector investment boom. So overall, we do think that there is a high quality nature of the investment that we're seeing in AI. And just a quick slide on the AI adoption itself. Approximately 50% of businesses are either thinking about investing in AI agents or are using AI agents. So again, this is really just to reiterate the point that AI adoption is real, it's ramping up, and ultimately this is going to lead to margin expansion going forward for corporates that do adopt the technology. The other important thing for investors to think about when they're thinking about AI exposure is that most investors, in fact, already have AI exposure in their portfolios, even if they don't know it. So when you think about the largest businesses on the global stock markets, it's the hyperscalers, it's the platform businesses. These are companies like Amazon, Google, Microsoft. They make up about 11% of global equity markets as a group. Secondly, you've got AI infrastructure and hardware companies, like semiconductor companies. Companies like NVIDIA, ASML, they make up another 9% in global equity markets. And then thirdly, there's another group of companies which you could consider AI adjacent businesses. And these could be software companies or companies that are providing services to the first two groups of companies, and they make up about another 2% of the global stock market. So overall, you're looking at about a 22% exposure within global equities to AI. So just to reinforce the point that most investors do actually already have pretty decent exposure to AI investment that's going on at the moment. And when we kind of think about some of those individual companies and the financial metrics that they have, we think they make a pretty compelling investment opportunity. So the four that I've kind of highlighted here, Google, which is Alphabet, Amazon, Microsoft, NVIDIA, they're all down between 12 and 32% from their highs. So there has been quite a significant pullback in these names over the last few months, which is obviously a good starting point if you're thinking about making an investment or allocating capital to these companies. The PE ratios, the price earnings ratio, is a proxy, the number that we use for valuation. And pretty much in all these four cases, the PE ratios are between 20 and 25, which is a small premium to the market. So in the US, the US stock market trades on a PE of about 20 times. So there is a small premium there. But the thing that gives us comfort is the fact that the earnings growth projections for these four companies are all very, very strong. So in the case of Alphabet, it's about 13% per annum over the next 3 years. And in the case of NVIDIA, it's actually 40% per annum over the next 3 years. So very, very strong earnings growth projections for all these companies, which we think bodes pretty well given the starting valuations that we're paying for them, and also given the fact that they've all had double-digit drawdowns over the last few months. And on the topic of drawdowns, I really just wanted to remind listeners that drawdowns are a feature of investing in the stock market. They're not a bug of investing. Each and every year, the market does decline between 10 and 15% on average. Sometimes it's less than that, and sometimes it's more, but on average, it's between 10 and 15%. The other fact that's important to remember is that most years, the stock market finishes higher than it starts. So the red dots are the intra-year drawdowns that I talked about, between 10 and 15%, and the grey bars are the calendar year returns for the stock market, in this case, the ASX 200. So that's interesting, but what's, I think, the most important takeaway from this slide is the fact that if you were to actually rebalance your portfolio, take some of the cash that you have in your portfolio and invest in the stock market when it is down, you are taking maximum advantage of this phenomenon that we see in the stock market. So we are very firm believers in rebalancing portfolios, and even more so when stock markets give you the opportunity when they're down. I think this is one of the more interesting charts that I've ever come across in financial markets, which is that the point is that perfect foresight doesn't actually prevent drawdowns. And what does that mean? So what we're looking at here on the slide is the fact that if we had perfect foresight of the best stock performers into the future, that is, if we bought the best 10% of future performers before they were the best 10%, we would still suffer from drawdowns. We would suffer from around 10 drawdowns of more than 20% going back 100 years. So really key takeaway is that even if we did have perfect foresight and we knew what the best future performance would be, we would still suffer from drawdowns. And just to put a little bit of data against another old classic investor adages, which is be greedy when others are fearful. What we're looking at here on the slide is the fact that when volatility and fear is at its highest level, that is when forward returns tend to be the strongest. So if you know when that peak fear moment is, you can make a lot of money in the stock market. But the general principle is that when you do see volatility pick up and elevate it, that is typically a pretty good time to invest in the stock market. In fact, the best time to invest in the stock market. So in the US, if you were to invest in the top proportion of volatility periods, you would end up making over close to 10% per annum in the stock market, which is above long-term averages. All right, so in the next section, we're just going to talk about interest rates and share market views. So interest rates here in Australia are on the rise. We've already had an interest rate rise last month. Interest rates sitting over 4% at the moment, and interest rates are expected to go up another few times, taking rates towards the high fours at the back end of this year. And the reason that interest rates are going up is that inflation is above the RBA's target band, and the labour market does remain tight. As I've alluded to earlier in the presentation, I think labour markets are going to loosen up over time as a result of AI adoption, but that's not going to happen immediately. So in the here and now, we do see interest rates on the rise towards the back end of this year. Now, casting our mind more broadly to the global equities market or the global share market, what we're looking at here on the slide is we're looking at earnings per share growth on the vertical axis, and we're looking at the relative valuation expensiveness of each stock market relative to their own 15-year average on the horizontal. So what you can see is the S&P 500 sits at the right-hand side of this chart, meaning that it is amongst the more expensive stock markets globally. The other thing to note is that the earnings growth for the US is also amongst the strongest globally at about 15% per annum. So you are paying a premium price for US stocks. However, in the context of earnings growth, we actually think that's a pretty decent investment sitting here today. So if you look at valuations adjusted for growth, the PEG multiple is 1.3, so that's pretty good. Anything around 1 we consider to be good value or very good value. In contrast, the ASX 200, the Australian share market, the largest 200 constituents in the Australian stock market, is expected to deliver about a 10% earnings growth over the next year, and a PEG of 1.6. So on a growth adjusted basis, the Aussie stock market is not as good value as the US, but still better value than it has been 6 to 12 months ago. Now just drilling into the S&P 500, the US stock market, we can see in blue the price for the index has rolled over the last few months, but at the same time, the earnings, the orange line, continues to be revised higher. So that's certainly a dynamic that we'd like to see. And as a result of that dynamic, what we then see is the green line at the bottom, which is the valuation, has come down from nearly 24 towards the back end of last year, down to a PE of about 20 times. So the valuation has come down nearly 20% over the last few months as a result of some of the risks that we've previously highlighted, including the Middle East conflict, as well as the AI implications. So look, sitting here today, we actually think it's a pretty good starting point for investors going forward. And now looking at the ASX 200, so the largest 200 companies here in Australia, we've long been kind of semi-cautious around the Australian stock market. The main reason is that valuation multiples were getting up there and earnings growth was pretty anemic. So that's kind of flipped around quite a lot in the last 6 months. So we've seen earnings growth pick up quite meaningfully since about September, October of last year, which is a very healthy development. And over that same time frame, the stock market's basically gone nowhere. It's gone sideways. And so similar to the US, what that means is that valuation multiples have come down from around about 20 times to 16.5 times PE. So quite a nice discount in the valuation. And so sitting here today, we actually don't mind the Aussie stock market as a home for capital. It also has nice complementary features to the US. It's different sectors, financials and resources being the two big ones. So both of those sectors will provide complementary movements compared to the more tech and communications heavy market like the US. On the next couple of slides, we're just going to go into a couple of case studies and really looking at two of the biggest and most important stocks in both Australia and the US, being CBA and Microsoft. Now, the purpose or the reason for doing this comparison is the fact that CBA has been one of the best performing stocks in the Australian stock market over the last decade. It's delivered investors exceptional capital growth, and so has Microsoft, to be fair. But what we really wanted to position was a couple of things. We wanted to look at valuations, and we wanted to look at earnings growth. So firstly, on valuations, Commonwealth Bank is very, very expensive, statistically speaking. It's trading well above historical averages. It's trading outside of the normal standard deviation bands, which are the red and the blue lines on the charts I've got here. And so that's not a great starting point if you're thinking about allocating capital towards a stock. You don't want to be buying a stock when it's very, very expensive. In contrast, Microsoft, you can see on the right here, is actually trading cheaply. It's trading below its kind of recent multi-year average valuation multiple, which is what this line is showing. And it's also trading statistically cheap, as it is trading more than one standard deviation below its trend level PE multiple. The next aspect I really wanted to just highlight was the growth, the earnings growth. And earnings growth really over the long term is the key driver for share price growth. If you're only looking at one thing, that's the one thing you want to look at. So firstly, CBA has delivered around about 1.6% per annum of earnings growth over the last decade. Now, 1.6% is exceptionally low. That's not great. Meanwhile, the stock price has moved a lot higher than 1.6% per annum. In fact, its valuation has gone from below 15 times to over 26 times. So all of the share price growth, or the majority of the share price growth over the last decade, has been driven by valuation expansion. So around about 8% of the 10% per annum share price growth that you've achieved in CBA has come from valuation, not from fundamental earnings growth. So not a great story there. In contrast, Microsoft has grown its earnings by 20% per annum. And over that same time frame, its valuation has only moved up by about 2% per annum. So it's fundamentally a much stronger firm than it was a decade ago, as evidenced by its earnings growth. But at the same time, valuation is pretty much the same as it was, or very close to the level it was, certainly 6 or 7 years ago. So fundamentally, we think the valuation for CBA doesn't make a whole lot of sense in the context of its earnings growth. And in contrast, we think Microsoft, as a proxy for US equities more broadly, is very high quality, has grown its earnings at very high clips, and is expected to continue to grow its earnings at high double-digit rates going forward. So really, bottom line that we're trying to get to here is the fact that investors that are only looking at Australian equities are really shortchanging themselves, because there are some fantastic investment opportunities offshore, as evidenced by their fundamental growth in these types of companies. So wrapping it all up, what does this mean for portfolios? So implications for the portfolios. Look, equities are the long-term growth engine of investment portfolios, and that is because earnings growth is the key driver of share prices. And over the long term, corporate earnings do in fact grow, particularly when you're investing and leaning into quality companies providing essential services and operating in favorable industry structures. Important point to note is that investors that stay invested during drawdowns, during crisis periods, are going to be far, far better off and closer to reaching their long-term growth objectives than investors that bail out at the wrong time. And plenty of investors do that. In terms of international equities, I think I've highlighted pretty clearly why we retain a preference for international equities, as evidenced by some of the AI trends that I've talked about, as well as that sort of brief look at Microsoft and the fundamental growth that it's delivered and is expected to continue to deliver going forward. And given the fact that there is a broad range of opportunities offshore that simply we cannot access in the domestic corporate market. And I do also want to acknowledge the fact that there has been a pretty good improvement in corporate earnings growth here in Australia over the last 6 months. So by no means are we saying that investors should be, shunning the Australian stock market. That's not what we're saying. But we do think that having that diversification is really, really important. Also, drawdowns and volatility. We kind of see these as opportunities for long-term investors, and I know most investors that listen to these presentations are well aware of that and are keen to deploy capital when markets are giving them that opportunity and that drawdown. The other point I just wanted to highlight is the fact that the recent sell-off in the market, due to the Middle East conflict, amongst other things, has reset valuations in a lot of those high growth sectors. So that's a good starting point, and we are of the view that investors should be selectively adding to their favorite stocks that are trading at a bit of a discount to recent valuation multiples as a result of broad-based market selling. Fixed income, we've talked about this for several quarters, is a really great place to generate high levels of income and relative capital stability, so providing ballast within portfolios. So super important. And finally, asset allocation and portfolio rebalancing are really vital for investors to take advantage of the dynamics that we see year in, year out, of having those short-term dips in the market, but ultimately finishing higher than where they begin for the most part. So thank you for your attention. Thanks for your interest in today's video. If you do have any other questions, please head to our website or reach out to your financial advisor. We look forward to speaking to you soon.